Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Before we get started, please like, comment, and subscribe, and be sure to visit the Pacific Point Research Lab on our website. And while you're there, be sure to sign up to receive our research delivered directly into your email inbox. Let's get started with a very simple framework that we use at Pacific Point to evaluate the likelihood that the U.S. economy falls into recession in 2023. Before we get started, I wanted to remind everyone to watch last week's webinar. Last week, we looked at the manufacturing and services sector's contribution to U.S. economic activity to answer the question, when is the Fed likely to stop raising rates? Over on the left side of the slide, you can see that I've got the research lab highlighted up here on the Pacific Point website with the webinar section. You can see last week's webinar, when is the Fed likely to stop raising rates? This week, we're going to shift our focus to the personal consumption expenditures contribution to U.S. economic activity. We're going to couple that with unemployment rates to answer the question, will the U.S. economy fall into recession in 2023? A popular rule of thumb is that 2 consecutive quarters of a decline in GDP constitutes a recession. Problem is that investors are continually bombarded with opinions regarding the likelihood of recession without any facts or context to back the likelihood of such an event taking place. And you can see up on the screen, I'll just throw up a couple of the headlines that I've seen just literally in the last couple days, if not the last week. This one from CNBC, Biden says he doesn't think there will be a recession. If so, it will be very slight. Obviously, we all know what kind of recession we're going to have, right? If we're even going to have a recession at all. These are clearly just opinions, not very many facts associated with these types of headlines if you read them. The next one comes from a Motley Fool service called The Ascent. Headline reads, I'm not worried about a recession in 2023. Here's why. A lot of this is obviously clickbait. But a lot of this stuff can be poisonous if you try to ingest this every minute of every day. It's literally everywhere. Here's another headline from Bloomberg. Forecast for U.S. recession within a year hits 100%. Wow, that's a vote of confidence. Another one from Sky News, and this one's actually come across numerous media outlets from the IMF. The worst is yet to come, the IMF says. 2023 will feel like a recession. And I don't know about you, but no recession that I can recall has ever felt the same. So if somebody can tell me what the 2023 recession may feel like, if we even have one, that would be interesting. Next one from the New York Post. Again, this one was strewn across numerous outlets. Jamie Dimon says the U.S. world headed for recession in 2023. This is serious stuff. Another one here, Mark Zandi warns a recession may come in the second half of 2023, but you're not given a lot of solid facts behind this. These are really just opinions or strategists coming out with their opinions. Goldman CEO David Solomon says there's a good chance for recession, so it's time to be cautious. So let's set our opinions aside. Let's look at some of the mistakes that investors and investment professionals actually make when trying to quantify the likelihood of a recession. And then let's explore the analytical framework we use here at Pacific Point. I think you're really going to enjoy this. So the first slide we're going to start with is the personal consumption expenditures. And note that personal consumption actually makes up 71% of US GDP. And the Fed needs consumption/consumer spending to decline to bring supply and demand balances back in line to beat inflation. The point here is that the analytical framework we use at Pacific Point focuses on the consumer and specifically consumption and consumer spending, which has steadily grown in its percent of real GDP over the last 30 years. And I'm just going to throw my laser pointer on here. I'm going to have to take it down in a few minutes, but for now we'll use it. And you can see this rapid rate of increase in the percent of contribution that personal consumption represents of real GDP. It's just grown astronomically to literally 71%. So here's where we're at today. Okay. So super important to understand that as we move through these slides. So next slide, we come to the first issue, right? And the idea here is that all investors realize that changes in consumption / consumer spending will have an impact on GDP and in turn influence recession risk. But again, as we've discussed, right, most struggle to quantify this. Here you can actually see the Federal Reserve's preferred measure of economic activity in the form of the raw data series for the personal consumption expenditures. And here the problem is that this is a growth series. And even when plotted on a proper log scale, there is no level, and I'm gonna stress level, okay? Because what you're looking at here when you're looking at these growth series is you're looking at simply just levels. And you can see that each level of personal consumption is associated with a different point in time period of recession, okay? So the part I want to emphasize here is that there's no level of personal consumption that is statistically significant for determining recession risk. So you can't really look to the personal consumption expenditures series itself for that type of information. The proper way to look at this series is to actually transform this series, and you can see why it's easy, or you can see why investors struggle to quantify recession risk, right? So even when we transform the series into a 1-year percent rate of change, you can see that we end up with the Fed's preferred measure of inflation, right? You can see that 6.25%. But as we saw with the last chart, there is no rate of change in this case. And I'm going to stress rate of change. Last chart was level. Since we've transformed this into a 1-year percent change, now we see that there literally is no rate of change that you can point to say, oh yeah, that's going to lead us into a recession. So again, no rate of change in personal consumption that is statistically significant for determining recession risk. So again, this can leave professionals and individual investors kind of scratching their head. And you can see I've got a little question mark out here to the right in terms of, well, where do we go from here? Are we in a recession or not? So we run into the third issue, and this is where we kind of bring the concept of unemployment together with this concept of consumer spending and personal consumption expenditures. And the idea is what's the quickest way to curtail spending, and that would be to knock the legs out from underneath the labor market. So we look to unemployment then as professional investors and investors alike to try to get some pulse of what's going on and trying to determine this risk of recession, right? So all investors, again, realize that unemployment at some level does compound this role of consumption / consumer spending in causing a recession. But again, most struggle to quantify it. And you can see here that when you look at that headline U3 unemployment rate, this is the unemployment rate that you hear quoted in the press and CNBC, Wall Street Journal. And you can see that there is no level of unemployment that says, oh yeah, at this point we're going to have a recession. Okay, so you can't really point to that, even though we're sitting at near record low 3.5%. And you hear that all the time. You can see I've got another red question mark. We don't know. I mean, could we go all the way down here to roughly 3% like we were back in the 50s? And that's what I love about these deep historical time series that we have access to in our research labs. We can do this type of research. The answer is we simply don't know. We can't say with any vote of confidence that, yep, 3.5%, we're overheated. Boy, we're going to go into a recession, because you can see that we've had recessions start as high here as 7%, and the full range from literally 2.5 all the way to 7%. I've got them all marked here with these little red horizontal lines. Each of the gray bars themselves are obviously your recessions. Okay, those are your recession periods. So the result that we're left with is that we just get bombarded with these opinions, right? And we see this every day. Well, inflation's this, we're going to have a recession because the Fed's got to raise rates. And the idea is that we look to our experts, right? We look to our Federal Reserve Board governors, their speak on a weekly basis. And we've got a pretty good idea that this unemployment rate is probably going to need to rise. And we've heard estimates anywhere between 4.5% all the way up to 7%. I actually heard an estimate or a forecast yesterday by a former Federal Reserve board member, upwards of 9%, which I thought was a little bit outrageous. But at any rate, we know that this unemployment rate is going to need to rise. And so that's something that we're going to pay attention to here in the next slide when we talk about the framework solution, right? So at Pacific Point, anytime we are looking to determine the likelihood of a recession, what we do is we mathematically transform the headline rate of unemployment to bring statistically significant explanatory power to the combined effects of consumption / consumer spending, right? Together with the headline rate of unemployment. So I didn't draw any lines on this chart, but you can see the relationship clearly prior to each recession. So the framework solution is, and this is the mathematical transformation that I'm referring to. And mathematical transformation is really a big word that only means that we're taking the current point of unemployment, or that current rate of unemployment, and we're literally just subtracting that from the year ago timeframe. So it's just a year-over-year difference in the headline unemployment rate. And the framework solution here is that a 1% year-over-year increase, and I've literally got this on the slide for you, in this unemployment rate has preceded each of the last 12 recessions back to 1949 with no false positives, right? So when we walk through this here, you can see it, okay? Each time that unemployment rate rises, the year-over-year difference rises more than 1%, we fall into recession, 1%. So 0 to 1. I've got reference line here, horizontal reference line from 0 to 1%. You can see that we're currently sitting here at negative 1.2, right? So that U3 unemployment rate is still negative in terms of year-over-year difference. But where we get into the danger zone, obviously, is when this goes from 0 to 1. And keep in mind that the current rate of unemployment is 3.5%. And the minimum that we've heard from economists, strategists, and former and current Federal Reserve board members is that we're going to need to be at about a 4.5 level. So that brings us right to 1. So this, you can see the statistical significance here again, going from the 0 plot to the 1 plot. Each time you do that, you have a recession, okay? So a really, really strong statistical significance. And this is the framework that we use at Pacific Point to determine the likelihood of us falling into a recession, specifically in 2023. So we're keeping our eyes on this point right here, and we are expecting this point, if the Federal Reserve continues on its path, okay, for this to actually breach the 0 line and actually approach, if not breach, the 1% year-over-year difference, okay? So what can we do here in terms of forming a conclusion? So what I want to do is I just want to kind of walk through this very, very slowly, right? The idea is that everyone is going to have an opinion about the likelihood of the United States heading into a recession in 2023. And our recommendation is to stick to the basic economic facts as you know them, right? And use those facts to draw your own conclusions. Specifically, follow the framework and use what you've learned here today to kind of challenge what you read, challenge what you hear, and just revert back to that year-over-year difference in that unemployment rate. Because we know that the Fed is targeting a tight labor market to moderate wage growth and to help temper inflationary pressures. We also know that the Fed needs to increase that rate of unemployment to increase the pool of available workers to bring wage growth down. I mean, this is what we hear about every single day, right? These are facts. Officials estimate unemployment rate needs to rise between 4.5% to upwards of 7.5% to address that 40-year high inflation. I mentioned this on the last slide, right? True statement. That's the target right now. We know that an increase in unemployment will decrease personal consumption expenditures, and that represents 71% of US GDP, or 71% of US economic activity. We know that a decrease in consumption / consumer spending will lead to a decrease in GDP, but that does not guarantee us a recession, right? We've seen that in numerous slides today. We know that also there is no rate of unemployment that is significant for determining recession risk. We know from looking at our framework slide that a 1% year over year increase in unemployment has preceded each of the last 12 recessions back to 1949, okay, with no false positives. We know that Fed must raise the unemployment rate by at least 1% to breach that 4.5% unemployment rate threshold. And we refer to that up here in 0.5, right? This isn't our belief. This isn't our opinion. This is what's coming from Fed officials, strategists, economists, that we're going to have to raise unemployment by at least 1%. We know what happens when you raise unemployment by 1%. Going back to 1949, that's literally preceded each of the prior 12 recessions. Okay. So are we going to have a recession in 2023? The conclusion here is that if headline unemployment increases by 1% or more in 2023, history tells us we can expect to see a recession in 2023. That's about it for today's session. Thank you for attending. Be sure to join us next week when we explore the effectiveness of traditional asset allocation models. Thank you.